great stuff, then. I will get started, Dan, because we always think that there's not going to be that much to cover, and then Dan and I put our slides together and we found there's a huge amount to cover, and there's a lot in today. So welcome back after, I think it's been a little while since we had the last webinar. Things are still cracking on a pace with quite a lot of different things happening. Obviously, a big focus is on LGR, and I apologise to those of you on the webinar today for whom that is not relevant, but it is a huge thing within the sector, and it also does have some really important consequences for what we're doing as well in the main service around funding, which we'll cover in quite some detail, and hopefully that'll be really useful to everybody. Then Dan's got some really interesting early indications of what's coming out of the financial accounts. The final accounts, that he'll give us a good run through of that, and also some indications of looking forward to the potential SEND deficit forecasts, and also some implications for resilience around LGR as well. And then finally, very quickly, we'll look again at SEND and the high needs deficit grant. We sent out a briefing note earlier this week, and we've got quite a lot of questions coming back about that. So there's quite a lot to cover. Just to remind you as well that we're recording the session today, so the recording will be available on the website tomorrow morning. And could everyone just make sure that they've muted themselves? I think one or two of you got. That's great, perfect, thank you. So starting off with the LGR funding disaggregation model, it's something we started doing last year. First of all, looking at the 25-26 distribution, and then updating it for our forecast last summer. Over the last few weeks, we've issued an updated version which follows the final settlement earlier this year, and it creates a disaggregation model for any county area for the next 3 years, 26, 27, 27, 28, 28, 29. So it does that over the 3-year period, and it works on the basis of existing district boundaries. All our subscribers have already bought that model, so it's just now available on the website if you want to go and have a look at that and use that. The key development, though, in the last few weeks is that we've made a lot of progress unpicking the key relative needs formulas. So children's, the 2 adult social care formulas, and the foundation formula. And a huge amount of thanks needs to go to the technical team at Essex County Council, who've done a huge amount of work on particularly the children's formula and the adult social care formula. So I think we're really quite confident now that we've got to the bottom of what's going on in those 2 formulas. I mean, I have to say, even replicating it has been an enormous piece of work, incredibly complicated. But I think we have at least got that data and that insight, those formulas now that we can use both for LGR, but also more broadly in our forecasting for the general funding formula. As we know, there are announcements that have already come out for 4 county areas. Essex is being split into 5 unitaries, and then for Suffolk, Norfolk and Hampshire, complicated splits on the basis of parishes, so not using the district boundaries. So our model, while it will be a good platform for those 3 counties, we'll need to do a lot more work to make that model work for LGR happening on non-district boundaries, on parish boundaries, and we'll talk to those authorities separately. But we'll try and share as much of the work as possible across all areas that are affected in that way. And of course, we're expecting potentially more announcements in July on the remaining 2-tier areas. Very briefly, historical context, because you will have seen this, and I apologise to those of you who are on the CCN webinar yesterday. We've covered quite a few of these slides yesterday, but they're relevant, I think, across the sector, so it's worth looking at them again. But first of all, just thinking ahead to 2028-29, an enormous number of new authorities are being created in 28-29 already, with the existing decisions that have been announced. 17 new authorities, including 3 new fire authorities. That compares to 21 new authorities created through LGR over the last 20 years. So they're almost doing as many in 1 year as they've done over the last 2 decades. So the sheer scale of that's huge. And obviously that puts a lot of pressure on the sector, on Whitehall, and on consultancy support as well. Is there enough capacity to do all that work and all that change? And then splitting, we've never had counties split into more than 2 since Berkshire in 1998, and we've not had any split on the basis of anything other than district boundaries or county boundaries since 1974. So we really are doing something in 28-29 that's a scale and complexity that we've just not got any experience of. So the risk clearly is enormous. As I mentioned, I think the work we've done on the LGR model has got huge implications for our pixel fair funding model. As you recall, this is a model that we've had in the past, which seeks to forecast or explain how the current funding distribution works. And now that we've bottomed out things like children's and adult social care, as well as foundation formula, I think we're quite confident now of being able to use that work to create a new fair funding model over the summer, which we can then release to you, and you can look at how those formulas have been created and calculated, how they distribute funding, etc., and just get more understanding of what's going on, and then using that to forecast what that might look like in terms of the distribution of funding in 2029-30. So I think it's got relevance for the whole sector as well. So I'm just using the slides that Essex County Council went through in our presentation to county councils and county unitaries yesterday afternoon with their permission. So just as I said, they've done a huge amount of work on the children's and adult social care formulas, and clearly that it's really important to make sure that when you're doing LGR that you've got as much understanding as possible about how the formulas work, how funding is currently distributed, so that when you disaggregate funding between new unitaries, it's as close as possible to the actual distribution of funding that's in the settlement. So that when you, first of all, so that in 28-29, your funding is, you're not underfunding or overfunding areas relative to spend. It's got the correct amount of funding in each unitary. But also in 29-30, we're expecting a new funding review, a new funding formula, and you want as the cliff, you don't want cliff edges in funding between 28-29 and 29-30. You want as smooth a running as possible. You want to be as accurate as possible in the way that you allocate funding through local government reorganisation. One of the key features and slightly odd features of LGR, as those in Northamptonshire and Cumbria will know, is that government doesn't really help you disaggregate funding when you're doing LGR. It basically says you've got a control total of funding to distribute. You fund it, you disaggregate as you wish. They may look at the modelling that you've used towards the end of that process, and in my experience, they won't really say very much about it. So it really is over to you as an area, as a county, to disaggregate funding as in the way you think is most appropriate. Some good background here about how the modelling works. We've disaggregated relative needs assessment, and we made a lot of progress on that. And also we can disaggregate the resources adjustment. A lot of that's based on what's in our MTFP model, but also we've obviously had to really do a lot of work on the RNFs to disaggregate them down to district level. Looking at the adult social care relative needs formula, detailed here what's in the actual explanatory notes that were published alongside the settlement. And you'll see here to some degree that the adult social care formula was relatively similar to those we've had in the past. You can see the fixed amounts per head. You can see the values for each of those individual indicators. The one thing I think we struggled initially to replicate was the low income adjustment. That had quite a complicated formula in there, which we've now managed to do. That was something that was in the older people's formula. So I think we're pretty confident now that we've been able to replicate that formula. A lot of the data sets were broadly accessible through the ONS, through NOMIS, through Stat Explore. I think the limitations or the concerns that we would have are really more about whether we've selected the correct dates. The sources were given in the explanatory note, but it wasn't clear exactly which dates governments used for the formulas. So that could cause some variances, but those variances shouldn't be significant. And what Essex did, and that we've obviously used in our modelling now, is to compare their calculated values. You see the bottom left chart, the calculated values for each local authority compared to the values that are in the settlement. And as you can see there on that chart, the R squared is 0.999, so pretty much a perfect match. Clearly some variances here and there, but broadly we're pretty confident now that the modelling we've got within the LGR model replicates what's in the final settlement, which is comforting. So you can see that the county areas correlation 99%, standard deviation just over 4%. So there are some variances but they're not particularly significant. Although, as someone pointed out to me yesterday, if your variance is 4%, that could be quite significant. But nevertheless, I think we're fairly confident that that does replicate what's going on. And so it's a good basis for disaggregating funding to district level, but also I think a good basis for looking at what's going on in the future and understanding what's happening with the formula on a national level. For children and young people, RNF, this was a formula that was extremely complicated. You see here the large number of indicators, each indicator operating on the basis of for children in need, children looked after, and ceased care. And the actual calculations, although they were set out in a very summary level within the technical note, actually performing those calculations within an Excel model are extremely difficult. Some of those functions I wasn't aware of before, so I've been on a bit of a journey, a bit on a learning curve to understand what's gone on there. So very grateful to what Essex have done to unpick that. I mean, the model itself operates at LSOA level, and those LSOA level values are then aggregated up to each local authority. So you can then obviously aggregate those LSOA elements up to each district level or even parish or even ward level. So it operates at a very, very detailed level. So the size of the model is huge. The one that the Essex have that works for the whole country is about 300 megabytes. So it's a huge, vast model. We've replicated that in 3 separate sections to make it a bit more usable, but it does seem to perform the right sort of calculations and outcomes. There were some data sets we couldn't obtain properly. Free school meals was one. We've had to get those at constituency level rather than LSOA level, but our view is it probably doesn't cause significant variances. And as you can see here, again, bottom right, looking at that correlation between the final settlement allocations and those we've calculated in the model, it's an R squared of 0.993. So again, really, really close to what's going on in the settlement itself. So again, I think a high degree of confidence there about what's happening within the children's RNF, and similar sorts of things there about slightly greater standard deviation, but pretty much we're fairly confident about having been able to replicate the formula. We've done something similar on the foundation formula side of things. The R squared here is slightly lower, 0.9863, so it's fairly close, but it's not quite as close as the children's and adults. In terms of data, we were fairly confident with mid-year population estimates, IMD and area cost adjustment. They're available broadly in the settlement. Net in commuters, we were able to calculate that from the ONS commuter data from the census. So that's basically set. So if you have net in commuters, you get a value. If you've got net outflows of commuters, that's set at 0. But for day visitors and overnight visitors, we couldn't crack the data that's given in the settlement. The sources were not particularly clear, and I'm not sure how they've calculated the actual local authority level visitors and visitor data, never mind splitting that down to district level. So I think there's quite a significant potential for error there around visitors, and potentially some significant under or over allocation. And you can see there as well, there are some types of authorities that do seem to be slightly off that line of best fit, places like Kent and Essex in particular. Potential there that we are understating in our calculations, so overstating in our calculations what we think their funding is for the foundation formula. But broadly, I think we're pretty much there in understanding what's going on there. And I just wanted to use the Essex modelling as an example, an indication of how the funding is distributed on a per head basis for the key RNF. So you can see here, these are the 12 districts within Essex and showing the IMD for each district. So there's quite a spread of IMD within the county, Tendring having a very high level of IMD, 32.1. At the other end of the scale, Uttlesford, a low level of deprivation, 10.0. So a wide range of different outcomes. In terms of upper tier foundation formula funding per head, you can see there's absolutely no relationship between deprivation and funding per head. And I suspect something of a surprise to me. I was expecting deprivation to be a much stronger factor because it clearly is one of the key indicators within the foundation formula, but it looks as though visitor numbers and commuter numbers has a more important effect on the outcomes. You can see there, Uttlesford, the least deprived, has by far the highest amount of funding per head, and that's because it's got a large amount of visitors, because it has a large airport. So that's something of a surprise. Older people, pretty flat across the whole area, slightly higher in Harlow, which I think is possibly to do with the adjustment for low income and for the ability to self-fund. But in terms of needs per head, pretty constant across the whole area and not particularly related to deprivation. Younger adult social care, a little bit more linked to deprivation. Certainly the three on the left that have got the highest levels of deprivation have clearly got the highest levels of funding per head, Tendring, Basildon and Harlow. But the other district areas are wide spread in terms of deprivation, or relatively widespread, but very similar amounts of funding per head from the young adult social care. So a little bit more linked to deprivation, but not quite as much as I was expecting. And then we look at children's, and you can see here that the correlation between deprivation and funding per head for children's is very strong. Deprivation is overwhelmingly the most important factor driving the funding differences here. And the funding per head is very different. So Uttlesford is getting about a third of the funding per head as someone like Tendring with much higher levels of deprivation. So that's got important consequences for the way that funding would be allocated within LGR between district areas, but also I think it's got consequences for how we look at that funding formula on a national level, and how we think about just the degree to which that formula is distributing funding across the country. And this is one of the things we were looking at or wondering about at the time of the final settlement and the provisional settlement last year. What are the key drivers within this formula? And I think as well, one of the questions I think we can now start to answer when we understand how the formula works is we can start to see what do the different IMD formulas look like. So the formula has used the IMD 2025 post housing costs. We can look at what that would have done if the government had used IMD pre-housing costs, which clearly was one of the big contentious issues in the settlement last year. So we can start to unpick much more about what the individual factors mean, what impact they've got, what the drivers look like, etc. And the same thing with the foundation formula as well. We can look at the impact of deprivation within that formula. It looks to be a bit weaker than we expected, but we need to investigate that with a bit more rigor before we draw that kind of conclusion on a national basis. The model itself calculates the funding, the grant funding and total resources for each district area. So it pulls together both the county funding and the district funding into one block and allocates that to each district area. So we've used the model to extract everything here. And you can see here we've ordered each district area by IMD. So the most deprived on the left, the least deprived on the right. And you can see that in terms of grant funding per head, there's quite a big range between the least and the most deprived. Although the relationship isn't perfect, there are some big differences between between authorities with similar levels of deprivation. We also wanted to see whether things like urban, rural was a big determinant of grant funding per head, and it doesn't appear to be. So you have got some very urban authorities on the left-hand side. It says that places like Hyndburn, for instance, in Lancashire, but also that are very deprived and got high levels of grant funding per head. Other places, particularly in places like Surrey and Hertfordshire, Hampshire as well, they're classified as urban and they've got very low levels of grant funding per head. So the urban nature of a place doesn't seem to be something that is particularly a strong driver of high levels of funding or low levels of funding. But when we look at total resources, so we include council tax in there as well, much flatter distribution of funding per head across the whole of the two-tier county area. It is slightly higher in the more deprived parts of the county areas, a place like Hyndburn, Great Yarmouth, Tendring, etc. But not significant. Well, it's higher, but it's not the significantly higher levels of per head funding that you might have expected in those more deprived areas. I guess another way of putting that is to say that within county areas, total resources per head is a bit flatter than you might have expected. So implications for funding distribution, looking longer term and looking in terms of the way funding is distributed across the country. there's much less of a clear link with deprivation than I was expecting. I think children's RNF has got that very clear link. It's a very strong correlation with deprivation. But the other RNFs, there are clearly other factors that are driving the distribution at district level beyond just IMD and beyond just deprivation. The foundation formula had a particularly weak relationship with deprivation, despite our IMD being a really key feature of that formula. Visitors and commuters appear to have a much stronger drive than I was expecting. Older people, RNF again seems to be driven by other factors, such as other factors around demography and the scale of self-funders as well. So it's got quite, I think, important implications for funding distribution. Yeah, and I think in terms of LGR, the issue here is that it's got the potential then to allocate funding into areas in ways that are unexpected and not necessarily similar to the way that spending's distributed. So that will be the key challenge for those of you who are putting together, financial plans for new LGR areas over the next year or so. How do you deal with a situation where actual funding in an area is different from actual spending in an area? How do you resolve those two things together? There are other elements within the SFA or the FFA that we haven't been as successful in cracking, things like temporary accommodation, homeschool transport and high-risk maintenance, mostly with high-risk maintenance because it requires local data. But these are areas that we haven't been able to unpick, but they are relatively small. So the main formulas will explain about 87% of the distribution of needs. Temporary accommodation, homeschool transport are worth around 3 or just under 3% of the needs share in total. So they're relatively small. And then with the resources adjustment, we've been able to, I think, fully replicate what's going on there in terms of the working age, including the working age LCTS adjustment as well. For those of you who have the misfortune to be working on non-district boundaries with your LGR financial plans, as I said, it's something that's not been done since way back in 1974. Much more complicated. The risk of material error is much, much greater. Some of the data sets are just not available at ward level, and I think almost nothing is available at parish level. So I think one of the challenges for those of you who are doing this kind of work is to try and translate the parish-based boundaries into wards so that data can be collected and we can have a reasonable go at recalculating the funding allocations. I think trying to do it at parish level just won't work because the data is just not there to do it. But overall, the model will become huge. It becomes much more unstable, much more vulnerable to errors and incorrect data as well. So it's a really big challenge. We will use our LGR funding disaggregation model as the platform for that, for try and use as much of that as possible and share as much of that as possible between you where you do have to use parish boundaries. But inevitably there will be a lot of specific work for each county to try and create those data sets and then put them into the overall model. Broadly, is the whole thing deliverable? I think we are now more optimistic than we were about 6 weeks ago. I think having that much better information about the key RNFs makes a big difference. I think to not properly understand children's in particular was, I think, a big drawback, and some of the issues around ASC and the foundation formula were troubling as well. But I think we've got a much better grip now on what's going on. There's obviously always a risk when you're disaggregating funding or the county funding into many small areas. So, to have to split it between 5 new unitaries does introduce quite a lot more risk. And where you're having to do it on the basis of parishes, there's a huge amount of new risk. So I think our view is that it is technically possible, but it's going to require a lot of work. Ideally, more engagement from central government, but I don't think we'll get it. I think authorities will be on their own when it comes to disaggregating funding. I think where there's gaps in data or we don't understand the formula, that does open up the greater potential for local challenge and disagreement. But I think those areas are relatively small now. So I'm fairly confident that the modelling we've got will give you a funding disaggregation that's pretty accurate, and also one that you can agree with all parties within an area without much disagreement. Okay, Dan, hand over to you.
Thanks, Adrian. So I've got 2 parts to what I'm going to run through today. Start off with first analysis of the 25-26 accounts for those that have been published already. And then I'll speak a little bit about LGR in terms of balance sheet and financial sustainability. So if we move straight into it, Adrian. So far, as last year, the publication deadline for accounts is the 30th of June, but as last year, quite a few authorities still work to a 31st of May deadline, so we've been able to pick up some information. It'd be really great if in the chat at some point over the next half hour, you could just give me an indication as to when you intend to publish. The mood music is that most people I've spoken to, even if they hadn't published by 30th of June last year, look like they might do this year. So it'd be really interesting to see if that's the case, or whether I've been told there's things around indexation on PPE that slowing people down, but generally people more positive than they've been in recent years. So what you're about to see only comes from 18 authorities, 7 districts, 6 unities, 4 Mets and county. So we're only talking about 6% of English local authorities. However, I think there's some really strong trends already that we can pick up, and then there's some that I'd caveat a little bit until a bit more information's in. But let's get straight into it, and we'll start, I think, with net assets. So balance sheets at upper tier authority for about the 3rd year running are shrinking. They're shrinking as a proportion of core spending power, so they, in real terms, they're shrinking. And there's a number of reasons for that, and we'll go into that. But if you look at this, it's colour coded. Left-hand side is upper tier, right-hand side is district. Upper tier, you've got yellow unitary, green county, red Mets. You'll see there's no blue on there at the moment because no London authority has yet published. But what you're seeing is the upper tier authorities are shrinking. That's largely to do with ever-increasing DSG deficits and other issues. But the districts is only one of those districts where the actual size of the balance sheet has contracted. In all other cases, it's increased. And this has been the case now for both upper tier and districts over the last 3 to 4 years. If we move on, I'll create what this is effectively from the 7 districts and 11 upper tiers, a aggregated balance sheet for want of a better name. And in there, you can see what's happened to revenue reserves, capital reserves, usable reserves, all the unusable reserves, and then a few other bits of calculation, which I do. So if I just go through these briefly, go on to the next slide, I think I've highlighted one. So usable revenue reserves have gone up, and unusually they've gone up in the upper tier. But the primary reason for that is one of the upper tier authorities to have published has £113 million of EFS monies that have boosted their reserves effectively. Without them, they would have used reserves. So if you imagine you take 113 million away from the 25-26 number, there you suddenly got upper tier reserves going down again, which is the same as in previous years. And we'll look at that in a little bit more detail in a second. But again, all roads for me seem to lead to DSG deficits, which so far are up 86%. So again, having doubled last year, they almost look like they're doubling again. Not quite, but at the moment, every single one of the upper tier authorities that has published of the 11 has an in-year DSG deficit. So usually that means an increase in the accumulated deficit or a surplus that's rapidly moving towards deficit position. Take those two things together and create current resources. So by current resources, I mean all of the reserves, be the revenue or capital, and some of the adjustment accounts. So I'll take the DSG adjustment account, for that is cash that's gone, and the collection fund adjustment account, that's cash that will have to go because you've got to fund the deficit if that's what you have. Taking that together, you can see resources have reduced in the upper tier, but they're still going up in district. So district reserves tend to be going up. They haven't got the sort of DSG pressures that the upper tier has, so resources go up. And I think that then has a knock-on effect for borrowing. Not so much the need to borrow, that's going up modestly, has done for the last 3 years, but the how that borrowing is funded. And what you're finding is an increasing squeeze on the balance sheets at upper tier, meaning that internal borrowing is no longer sustainable. And there's been a massive increase already from those 11 upper tier authorities in short-term borrowing collectively. The opposite is true of districts. More reserves, more cash on the balance sheet, and more of the need to borrow is being increasingly funded from within the balance sheet, so internal borrowing. So external borrowing, not an issue, hardly at all for the districts which have published so far. If we move on, have a look at that in a little bit more detail. So usable revenue reserve. So again, the top of each of these two graphs, the left-hand side upper tier, right-hand side districts, is the level of usable revenue reserves expressed as a proportion of core spending power, and the ones below are the change. And if you just look at the axes for a minute, you look at the district with the on that right that's got the lowest, it's somewhere just over 100%. And you look at the upper tier that's got the highest, it's somewhere well below 100%. You get the idea that districts tend to have a lot more in reserve than do upper tier authorities. If we look at the direction of travel, we look at the change. We've seen that the 3 of the 4 METs are doing okay, but one of those is the EFS MET, so that's done, that's bolstered effectively from that EFS. All 7 unitaries have seen usable revenue reserves fall as a proportion of CSP, and remember, CSP would have gone up by about 8% in the last year, so their reserves either increased by less than 8% or reduced. But districts would tend to see reserves having gone up, not in all cases, but there is a tendency for them to have gone up. I did wonder whether there'd be a bit of a district giveaway with the districts disappearing, same with counties this year. If it's happening, it's not happened in 25, 26, or at least not in the first few districts. If we push on one, Adrian. And if we look at the same sort of data over the last few years, this is in absolute terms, so this is in money terms. You're seeing districts are the 7 districts there. It's just them at the moment, so it's not everyone. It's just those that have published with their information from previous years. You can see that they're sort of edging upwards. The usable revenue reserves of the upper tier. Again, if we take the EFS out, you'd probably see another year going down, but what you're not seeing now, which we saw 2 and 3 years ago, is massive cratering of usable revenue reserves. It feels a little bit like that's starting to tail off. So I haven't yet seen some really, really big chunks taken out of usable revenue reserves this year. So tentatively, I wonder if actually the depletion of reserves across upper tier is starting to slow down a little bit, which is good news. If that's the case, and all of you out there who've still got to get your accounts out might prove me wrong on that, but it'd be interesting if it is the case that the cratering of reserves that we saw in 22, 23 and 21, 22 has slowed down somewhat. Move on another one, Adrian, if we can. Dedicated schools grants. So we'll talk a little bit more about SEND deficits, I think, at the end, won't we, Adrian? But from the 11 authorities that we've got here, you can see each one of the 11, slightly less than the METs, has an in-year deficit. Some of the deficits are still pretty considerable and growing at an accelerated rate. So the right-hand graph, the green line shows all authorities from last year, all 151. The blue line just picks out the trends of the 11 authorities, but you can see the lines are fairly close and you can see the line is plummeting. So you can absolutely expect that green line for all authorities to similarly plummet, unless those 11 authorities are really strangely different from everyone else, which I suspect they're not from what I've read. You're going to see another massive increase in DSG deficits. And actually, if we extrapolate and take the 86% increase in the accumulated deficits, you will be looking at over 7 billion by then 25, 26. And when I spoke with Adrian, I think we felt the government was thinking in terms of about 5 billion of high needs stability funding. Well, if 7 billion is correct, 90% of 7 billion is somewhere north of 5 billion. But we'll see, and we'll know more when more accounts come out. If we move on, another one. Adrian. So if I take what I observe together, reducing usable revenue reserves, if you take out EFS, and the EFS is really interesting, both in terms of reserves, but CFR, which we'll look at in a minute, you add to that DSG deficits, you've got a massive reduction in current resources, of cash-back resources on the balance sheet. Districts, you're seeing absolutely the opposite. You're seeing reserves go up. You're not seeing the sort of issues that you're seeing with DSG, and therefore you're seeing an increase in current resources. And if we move on, one that should show what's happening. So you can see across on current resources across all 11 authorities that have published, and therefore I suspect across most of the 151 when they finally do publish, you'll see the cash is being squeezed yet further on the balance sheet, and the opposite effect happening on districts. And if we move on one, I'll try and sort of explain the correlation, or the correlation at least that I see, between current resources shrinking and the sustainability of internal borrowing. So it's not a perfect relationship, but there is definitely a relationship between reserves falling, cash leaving authorities' doors because of DSG, and their position on internal borrowing. So there's not a massive amount of additional need to borrow. That'll be different when the London authorities publish, because there's a lot more borrowing, a lot more capital going on there. But there is this correlation: as cash reduces on the balance sheet, then so does the internal borrowing position. The problem is that the CFR is not reducing. If internal borrowing is reducing, then external borrowing is increasing. And what you see in that bottom graph is a massive, it's happened over the last 2 or 3 years, a massive increase in short-term borrowing. Now, that would have been all well and good 4 or 5 years ago when interest rates were at 1% and looked like being for some time. But my understanding is now that the market is factoring the next interest rate movement will probably be upwards, and maybe 2 or 3 ticks upwards. So there are a lot of authorities, I would say, stranded on high levels of short-term borrowing at interest rates that look like they might go up. So you can't fix to longer term, because they might be going up as well, and presume the long-term rates are going up in anticipation of future increases. But these self-same authorities are struggling with reserves that are falling and more DSG spend, which is causing a bit of a problem. And that's why, and I haven't put it yet, but you'll see in the next few slides, the High Needs Stability Grant, which will inject at least 5 billion into the upper tier sector, will almost be a game changer in saving some of these risks and mitigating some of these risks. If we move on, Adrian, we'll see how the opposite's happening in districts. So you've got district, a much clearer relationship between the resources on the balance sheet and the change in internal borrowing. They're very closely connected, and you can see there that internal borrowing for the 7 districts that have published so far, it makes up the majority of their borrowing. So they're almost hardly exposed to external risk as well. And when we look at things like interest receivable, districts are racing ahead from the 4 to 5% interest rates because there's so much cash on their balance sheet. It's the opposite happening at upper tier, where they're not getting much cash interest receivable because they've got no cash, but they are paying interest payable because they're having to short-term borrow. If we move on one then, so capital finance, getting back to the level of debt, you can see here that actually the problem is not the level of debt. As a proportion of CSP, debt is, the need to borrow is tending to come down, but external borrowing is rocketing because of the problem of balance sheets. So most upper tier authorities have seen a reduction in the need to borrow. So I don't think that, and this is the government, remembers, favourite debt level is the government's sort of single-eyed focus on debt, which I think misses the nuances within how that debt is funded. But if we move on, another one, debt gearing is interesting, because although the need to borrow is not really going up, the debt gearing, so the proportion of balance sheet assets that are funded by debt, is going up. Well, if the need to borrow is coming down and that's going up, it must mean equity is coming down quite considerably. And when you look at the capital adjustment account, we can see a lot of reductions in those. And I don't quite understand that, and it needs a little bit more work on it. But if equity is shrinking, if assets are deteriorating, or not being funded from grant or whatever it might be, then that might be a problem, particularly for upper tier. But a lot of that debt gearing as well, I should say, I think if you go on one, Adrian, yeah, there is impact of other things like the needing to borrow for EFS purposes. So the EFS authority, if you look at their gearing now, they're over 100% debt geared. So their debt is as high as their non-current assets, and that's because they're funding revenue through debt. So to a degree now, they're also using capital receipts, but they don't last forever, do they? And there might be a future need to borrow. So I think that's quite striking. EFS works, I think, in terms of the short-term gap. It injects a lot of cash in, but actually not all authorities have got the wherewithal to take the amount that they're taking on their credit card in terms of that long-term sustainability. Some will find that tricky, but that'll be an interesting one to monitor as we go on. If we move on, another one then, Adrian, I think. So in terms of capital health, the overall debt, I don't think is the problem. It's the makeup of that debt between short-term, long-term external borrowing and internal borrowing. And I think that's the issue, where balance sheets have been squeezed so heavily that there's a great transfer into short-term borrowing at a time when interest rates are really volatile and look like they might be going up. I haven't said much of this other than look at the capital adjustment accounts in reality of those 11 authorities. They're really plummeting. And to me, the capital adjustment account is a relationship between the rate at which you're funding your assets versus the rate at which they're deteriorating through depreciation or downwards revaluation. And if they're deteriorating at a rate that's much quicker than they're being funded, that means that there'll be a funding need in the future that's not being met at the moment. But it might just be that there are only 11 authorities, so it might be anomalous, this trend, but as more authorities come in, it'd be interesting to see what happens to that, because if equity is diminishing, then balance sheets are necessarily getting weaker. And if we move on, another one. So again, treat these conclusions with a good deal of caution, because there are only 18 authorities. As we get more, we'll have a look at that, and we'll be able to sort of update these analyses, see if those early signs continue. I think it's early enough, though, to conclude that there's definitely still financial stress within the upper tier sector, and much less amongst districts. You can start to see EFS permeating into the balance sheets now. I think it provides that short-term relief, but I'm not convinced in all cases the long-term sustainability looks any better for EFS, but that remains to be seen. And I think more than anything, I mean, if we say that the reduction in reserves and increase in DSG, that they're a problem in their own right, but they're creating problems around borrowing, then the 5 billion plus injection of high need stability grant will be a game changer in terms of providing that relief to the sector as a whole. What it won't do, though, is it won't address those old authorities that have still got other pressures and other problems. So we'll get back to the situation we had back in the Croydon Slough days, that there'll still be isolated cases. But for a couple of years now, I've been saying that the whole sector is going down the plug hole, at least at upper tier, because of the DSG problem. The government, in fairness, has done a really good job of, well, eventually should be doing a really good job of addressing that. So I think it will address the primary financial resilience problem for the sector, but it won't all go away. There will still be isolated authorities that are really struggling. And if we move on, shall I go straight through to the LGR stuff, Adrian? I'll rattle through this.
Yeah, go on.
Grand. So this now looks at last year's account. So all 151 districts and 164 districts are now published. So this information looks at that, and just look at the LGR. So if we just go on slide, just a reminder of the LGR criteria. There's all the criteria there on the left, all sensible enough criteria. But it's the thing on the right that absolutely got everyone obsessed, wasn't it? Everybody was obsessed by that 500,000 figure. I think a lot of proposals were based around that or defensive against that, and then everything changed and it wasn't really an issue. So if we move on one, we can see that the final decisions, DPP decisions, were completely at odds with the mood music. At least the mood music I was hearing, the 500,000 population, massive red herring. Sensible geography, which in my opinion was quite sensible, turned out to be the major criteria, but nobody knew it would because they're so sort of hung on that 500,000. Everything's changed, and Secretary of Change, state change, and the politics around the whole thing has changed. With the exception of Surrey, the government has now chosen for the most authorities of the proposals in each area, the largest number. And what I find really bemusing is West Sussex, who I think did a really good job of working together on their proposals. The government hasn't accepted them, and it's changed them. And I think I hope to show you it's changed them for the worse. So in terms of financial sustainability, so I'll just rattle through financial sustainability very quickly. If you move on, Adrian.
One more.
Yeah, so in terms of net assets, the thing to say here is that balance sheets across all the new authorities will have shrunk in 24-25 if they've been established then, but shrunk a little bit more others for it's a combination of reasons, DSG being one, West Surrey capital, a lot of capital write-downs or asset write-downs in around Woking and Spelthall maybe in West Surrey. But balance sheet's shrinking, that's the first thing to say. And if we move on one, looking at the next areas, so these the yellow areas of the DPP, blue areas are the 15 authorities that are left still to go. Net assets, they're coming down everywhere. They're actually quite higher than the unitary average across most authorities, but not all. Worcestershire, Lancashire, Devon, that still to make decisions have got low levels of net assets for different reasons. If we move on to usable revenue reserves, you can see that most of the authorities are doing okay for usable revenue reserves, and that tends to be because the districts, not so much the counties, the districts have got high level of usable revenue reserves. So when they run into the county reserves, most of the new authorities should be okay. But interestingly enough, the two that won't be, the two of the Sussex ones. Now, Sussex sees the extended Brighton. Brighton's got really low level of reserves. Don't know what will happen in 25-26, but really low in 24-25. And Sussex B, this is where it gets a little bit mad, really. West Sussex put in a thing, Chichester win with the three other coastal authorities in West Sussex. Government moved it out into the other area, and all the districts, including Chichester in that area, have got reasonable level of reserves. The three coastal, Arran, Edda and Worthing, haven't. So Sussex B, because of the government sort of manoeuvring, has looks like it might be vulnerable on reserves from the start. So that to me says, again, I'm never sure the government's got a really good grasp on the balance sheets of all of the authorities in England, but I might be wrong on that. If we move on one, we'll see where that there are still some areas, Kent, Lincolnshire and Devon, very low level reserves compared to others, but actually not that low compared to the unitary average. But they'll be, they might be a bit nervous on day one that, quite low level of reserves isn't so good. And the way then that's chopped up for the decisions might strand one or two of the authorities in that area with even lower than the average for the whole area. So it'll be really important that the government takes account of that. But I don't know that they've got that information personally, but we'll move on. DSGs, Essex and Brighton don't have, and East Sussex rather, don't have a big DSG problem. That means that we saw Brighton previously wasn't looking too healthy on reserves. It's not going to get any high needs stability grant because it hasn't actually got a DSG deficit. So actually it will still have a lot of problems, but a lot of these authorities will hopefully be saved now by the high needs stability grant, because that will flood more cash back into those new proposed authorities and give them some alleviation from some of the issues that we're seeing. If we move on one, we'll see that. And you get all these slides afterwards, so you'll be able to see it at your own time. So again, Worcestershire, Devon, very, very high DSG deficits. Actually, if you add if in both those cases, I'm pretty sure when you add those to the reserves, they're almost in a negative position. But hopefully, a good slug of the 5 billion will go to those areas, which will give their proposed unitaries in those areas a bit of a fighting chance on day one. If we move to CFR, it's the next one need to borrow. It won't be a surprise to you. West Surrey with Spelthorne, with Runnymede, and with Woking, and Surrey counties actually for a county has a high CFR. They've got a very, very high level of debt. That doesn't include the £500 million that might get written off there. South West Essex, next one has got Thurrock, so no sort of real surprise there. But and in actual fact, all the other areas not doing so bad. And if we move on to the existing areas, you'll see most of the blue, with the exception of Cambridge, are also very low levels of debt when compared. That suggests that if they are in the EFS position, they could probably sustain a bit of borrowing in the short term to sort their issues out. So I don't see a big issue for any of those authorities. And then finally, that relationship between current resources and internal borrowing. So you could see that West Surrey's got a massive amount of debt, but actually it's also got a high level of current resources. It's got high levels of reserves, and most of its debt's long term. So it's fixed at long term, so it's not internal borrowing. So they don't have that sort of resources internal borrowing risk, but Sussex C, which is Brighton, does. It's got quite a high need to borrow. It's not going to get any high need stability grant. It's got very low level of resources. So my guess is that new authority will be external borrowing quite early. And if rates do go up, that might be a problem for them. And therefore, even with exceptional financial support, it's going to be an issue for that authority. I don't know to what degree the government's considered that. If we go to the next one, it just shows where all the authorities are. So again, you haven't got any, compared with the unitary average, existing unitary average, I don't think there's any massive problems there. And whether, Devon's is quite high because it's got very low level of reserves, but again, its high needs stability grant should sort that. And then just one last slide from me, Adrian. So I think some of the proposed unitaries are going to start with challenging levels of financial health. West Surrey and South West Essex, very, very high debt levels. Some of the authorities, very low reserve levels. Lots of them with very high DSG. And that's where I think, again, high need stability grant will be a game changer in making many of those authorities a lot more sustainable than they would have been if the government had closed itself off to any support there. So I'd feel a lot happier now with high need stability grant as and when it comes, in terms of enabling those authorities to kick off with a fighting chance in respect of financial health. And that's me done. Adrian, it sort of takes us nicely into the your high need stuff, doesn't it? All roads lead to the high need stability.
Yeah, does fit. All roads lead either to LGR or to SEND at the moment. I think those are the two destinations for everybody. I mean, on SEND, I think we thought we ought to do something around SEND, around the DSG deficit, around the new high needs deficit grant. It's not something we've looked at in much detail for quite a long time now. We used to do a lot of work on schools 15 years or so ago, but it's not something we looked at because it's tended to be outside the main funding formula. But it's a significant funding stream for local government now, so we started to take a look at it, and we issued a briefing note earlier this week. We're not going to build the deficit grant into the model, simply because although it is grant funding, I think it's too closely linked to actual expenditure rather than based on any independent formulas to distribute. But it's something we're going to keep much closer eye on now. I mean, I don't want to go into too much detail because we've had that briefing note. We're kind of a bit short on time, but there are a few things that I did want to say. Obviously, looking at what the deficit might be, our forecasts are actually we had a similar sort of increase in deficit to those that Dan was looking at. About, I think ours was about 87%, Dan's was 86%. We were looking at some of the monitoring reports that councils were issuing. Dan's obviously based on the final accounts, and similar sorts of increases. That took us up to 5.5 billion based on the 31st of March 2005 deficit. So Dan, I have a quick look at our figures and just see what's going on, but it does look like there's a similar amount of increase. But if our forecast is kind of about right, 5.5 billion, then that would give us a £5 billion grant payment, which is in line with what the government's saying. But I know that the CCN ISOS SCT survey came out at about a £6.5 billion deficit, which would suggest a grant payment of closer to 6 billion than 5 billion. And based on Dan's numbers, that would suggest that if the deficit's around 7 billion, then that would suggest that the grant payments can be way over 6 billion. So there's still quite a lot of uncertainty about what that figure is. We just know it's going to be a big figure. So we know 90% of the historic debt as at 31st of March will be written off. I think, just speaking to authorities, there are increasingly some wrinkles that are being need to be ironed out. One is that the payment is not based just on the high needs deficit within the DSG, but on the total deficit, which is not entirely clear from the guidance. I know other authorities have been talking to government about whether voluntary contributions are taken into account, and they are. And we also know that, in other words, you don't get penalised for having made those voluntary contributions. And also we know that the safety valve payments are taken into account in the calculation as well. But looking back on it, that guidance, given there was a huge amount of grant funding, feels quite lacking in detail. But that also suggests possibly, and I think it's kind of backed up by the feedback I've had from councils, is that the way that grant works is still a little bit of a it's still under development, and is being developed under pressure from local authorities as well. So there is that level of uncertainty. I'm going to flip through some of these figures as well, because they're in the briefing note, and you can see the slides as well. The grant itself, I think, is kind of the third interim solution that the government's come up with. The statutory override, which has been extended out to March 2028, the safety valve programme, which has now ceased and been replaced by the high needs deficit grant, and then the new deficit grant, which will fund 90% of the deficits that authorities have at the end of the last financial year. So that was our forecast. So we applied our 87-90% increase in deficit based on the outturn, the £3 billion outturn that was in place at the end of the last financial year. So but that suggests, from our numbers, about £5.5 billion deficit. So what else I need to say here? Yeah, a few things I want to say about the variation in different figures. First of all, looking at the DSG high needs funding, obviously it's formula driven, and you can see here that different parts, London tends to have the higher levels of funding per head from DSG, and it tends to be what we've seen in lots of the formulas as well, although less so these days. Met's second highest amount of funding per head, followed by unitaries, and then finally counties having the lowest level of funding per head. So that's an interesting way of looking at what the government thinks in terms of its formula funding, about where the needs should be arising, where the pressures should be arising. We then look at where the actual grant payments will arise based on the actual levels of deficit across the country, and we see almost the opposite distribution of funding here. Counties, unitaries have the highest level of deficit per head and will get the highest grant payments per head. Mets have by far the lowest, and London slightly higher. So you see that it almost gets turned on its head there. But also you can see that the regional variation is quite interesting as well. The southwest of England has by far the highest deficit per head and will get the highest deficit grant per head, followed by the southeast and then the northwest. Some parts of the country have very, very little relatively in terms of deficit and deficit grant payments. And I think this is, it's obviously it's a really important thing that the government's committed such a huge amount of money to resolving this really, really important problem for local government. It's clearly it's an emergency situation for many authorities, but the one thing I would say is that it's a huge amount of money to be funding or distributing on the basis of actual expenditure. We haven't seen anything being distributed on that actual expenditure for quite a long time. It's not a good basis for distributing funding. I understand there's probably not an alternative at this point, but it is one thing to bear in mind. And just looking at the safety valve payments, this is something it's a smaller scale, just over £800 million over the lifetime of the programme. But you can see there that the distribution of that funding was not really linked even to the way that the deficit has been distributed across the country, never mind what the formula funding looked like. So, you know, the northwest of England, for instance, very high levels of deficit in the northwest, very low levels of safety net payments. There were no safety net payments at all in the East Midlands and hardly any in the West Midlands. So you can see here that I think the high needs deficit grant is a lot better in terms of distribution than the safety valve. But when the safety valve payments were distributed, it does make you wonder whether a lot of that was done on the basis of civil servant discretion rather than where the actual needs were arising. Then finally, so we're now looking at what the deficit payments will be. Look with interest about what Dan's numbers look like from the actual accounts themselves. That will tell us what the deficit looks like and what the grant payments will look like. Had a few questions about whether the grant payments will continue after you know, the current one we're looking at. So for the next 3 years. I mean, my assumption had been that they would continue and they would need to continue. Just asking around, some people have been involved in some of those negotiations, you know, confirming that it hasn't been confirmed whether that grant will continue, and it's not been confirmed if it did, whether it would continue at 90%. I think it's a reasonable assumption to say that it would, because without it, the accumulated deficit would again rack up very significantly, and councils will be back in the same position as they are now within a year or two. So I think it has to continue until government comes up with a proposal that deals with the underlying problems. That's what I'd say. Whether you take that into account in your budget planning or not, I think that there's a very high chance that this grant does continue in a similar form for the next 2 or 3 years. I'll draw it to a close there because we've kind of run out of time. But it's a really important issue we will try and come back to again, and we'll update with the data that comes out of Dan's analysis of the financial accounts. Then finally, just drawing your attention to, we have a webinar this afternoon on benchmarking for existing subscribers to that service. We are doing another, we'll do a benchmarking webinar on the 24th of June. That's for anyone who's interested in our benchmarking service. I'll send out details later this week if you want to register for that. And then we're also working at the moment on an updated version of the MTFP model. That will be available in early July, and we will hold a webinar on the 8th of July to talk about that in a bit more detail. Again, I'll send out details of that in the near future. And then finally, if you go to the CIPFA conference, we're going to be there for the first time in quite a while. So look out for us, and we have a chat in person for the first time in quite a long time. So there we are, Dan. There was a lot in there, wasn't there? Thanks to those of you who've hung around all the way through. The recording will be available tomorrow, and yeah, thanks very much. Now open to the floor for any thoughts or comments, questions. What are you thinking, Dan? That was
it's good. Thank you to all of those who put in the chat that they're going to publish by the 30th of June. No one's yet said they won't, so it feels a little bit like it just continues the direction of progress from recent years, where at least local authority finance teams get the accounts out. Whether your auditors will get you an undisclaimed audit in a true and fair audit in the same period is yet to be seen. I'm suspecting not, but everybody reckons they'll be published by 30th of June that has responded. So thank you for that.
Yeah. How much do you think, Dan, your numbers that you looked at today for the recent accounts are influenced by those who publish earlier tend to have healthier? Do they have healthier financial positions? Is there any link there between the health of your accounts and how early you publish?
I've looked at this in previous years, and yeah, there tends to be. But the earliest to publish was Bradford, and that they've sort of recently struggled. They actually published on 30th of April, which I was amazed at. But they've got the 151 who used to publish early at Oldham and Westminster as well, I believe. So but generally, yeah, I think certainly authorities that are really struggling often also struggle with the accounts. It kind of goes hand, not entirely, it goes hand in hand. So yeah, it might be that some of those figures deteriorate a little bit more from the late publishers, but I don't know. I feel a bit happier when we've got about 30 or 40, I think. Then you'll really start to pick off the patterns.
Yeah. But a lot of the answers you showed, just based on those few, it seemed to be quite consistent with previous years, as though it was giving a reasonably good indication of what you'll see when you get the whole lot.
Yeah, reasonably so. And I think particularly what would be interesting, I don't know if anyone wants to sort of add any insight to it, I think usable revenue reserves a couple of years ago across a good many of upper tier authorities, so we're dropping sort of 20 or 30 million on, on the sort of 100 million in a year. So often 20, 30% reductions in usable revenue reserves. That I haven't seen any of that yet, and that almost feels like it's bottoming out a little bit, and authorities are now getting to grips with the new funding envelope, etc. Now, I don't know, I might be proven wrong. I don't know if anybody here wants to sort of give any insight as to where they are, but it feels like last year it felt a bit disastrous ahead of there being no high needs stability grant, and I think the sector did a brilliant job on DSG deficits. I'm really shouting loud about that, and I think the government's listened to that. I haven't yet detected any big issues. The one thing for me that'll be interesting is starting to pick out EFS, because there's a lot of that in the system. And I think that sort of gives a slightly false impression of reserves, but actually can start to see it backing up in the CFRs as well. So being able to pick that out will be interesting as we go along.
Yeah. Dan Andrew book mentioned about whether we're aware that the high needs deficit grant is calculated on the total DSG deficit, so it includes surpluses in other funding blocks like early years. And I think Andrew's saying that we've got a surplus of 4 million on early years, so that would be offset. I mean, that's something that had come to our attention a short while ago. I think Rob Powell's mentioned that to me, that was something that had emerged. It wasn't clear from the guidance at all, but that does seem to have been something that MFCLG has been telling authorities in webinars and the like, but nothing published. So that does seem to be the case.
So Liverpool will lose out then, Andrew, because that surplus will net off. You would have otherwise got more for the deficit.
That's right. Yeah.
Our
high needs deficit alone is just over 12, and then when we add back in the surpluses on the schools block and the early years block, we anticipate the stability grant will be 4 million less. And I do wonder whether the earlier estimates are so far out that they've had to find a ruse to try and bring it back. Because it was very clear in the earlier guidance, and they referred to it all as the high need stability grant. But the recent sort of announcements, as you say, Adrian, from MHCLG, is it's very much the total deficit carried forward. So for the early years block, historically they pay on sort of an anticipated spend and then claw back the following year, so it's not uncommon to have surpluses carried forward on the early years block, and then it's offset against the following year's allocation. But I don't it just seems a little bit disingenuous to the original intent.
It does. And that's interesting, Andrew, in as much as I've noticed last year, Mets particularly had the lowest accumulated deficit, but they had the fastest growing. So I wonder if those that are much further on will get more of the grant, like Adrian said, that a lot of the counties, unitaries will. But I wonder if that phenomenon that you've just described will adversely impact types of authority more than others. I don't know. I suppose if it's ring fenced, it shouldn't, but be interesting to see.
Yeah,
I think something was worth looking at. I some of that analysis that we published in the briefing note I did a little while ago, so it was a little bit before we were aware of the other blocks being taken into account. So it's probably something we should look at, to be honest. It does feel like it sounds like it's kind of under development still. I know that the 90% was a bit of a surprise. I think the expectation before that announcement had been that it would be about 80% rather than 90%. So it was slightly more generous than was expected. But like you say, maybe started working through the numbers a bit more and thought, well, actually, it's going to be very expensive. And if it's close to what you're looking at, Dan, in terms of the deficit, then instead of it being a £5 billion grant, it could easily be 6, couldn't it?
Yeah, exactly.
Yeah.
A question for those of you who do the DSG note, because when I collect it from the accounts, I take the DSG adjustment balance and any positive reserves, and that usually agrees to the actual DSG note. Do you have to separate out high needs on the DSG note? I know most do, but is that a requirement? Because if it is and everybody does, maybe this year I'll start to pick off not just the accumulated DSG deficit, but the two elements, the high needs versus the other blocks. But is that a requirement of the DSG note? Do you know? Anybody? Anybody any idea?
I'd have to check, to be honest with you, Dan, whether it's an absolute requirement. We've been doing it for a number of years.
Yeah, most do, Andrew. I will have a look at the ones that have published so far and as they're doing. I might start collecting that if that actually would be quite useful from the accounts.
Yeah, that would be hugely useful. I think, Dan, if we can start to see that, and as well, government's probably working on the basis of the returns that you're sending rather than I don't know how much they actually look at actual accounts. They're looking at RA forms, RO forms, DSG returns, that kind of thing. But obviously the accounts should be the prime source for all that. So it'd be interesting to see what's in the accounts and whether they differ from. They shouldn't differ, but as you know, Dan, they sometimes do, don't they? They're always in line.
I just don't find I struggle all the time with RO. I just think there's half of them feel like a bit made up, really.
Yeah. There's a question from Matt there about how are councils expected to fund the remaining 10% other than borrowing costs that's been cost to the general fund or future DSG. Yeah, and that amount could be quite significant. So if anyone's got any views there about how you're doing that.
I mean, if we can already see that at 100%, it's throwing a lot of people into borrowing positions for DSG. So I suspect it'd be more of the same, won't it? If there's not any resources on the balance sheet left.
And you look at the numbers and you kind of model it through, and if that deficit, is almost doubling every year, it doesn't take long before the 10% of the unfunded 10% of the deficit actually becomes quite a big figure. The override's still in place, and the statutory override's still in place till in 28. So, March 28. So I assume that's how you'd handle it in the same way.
The scary figure, Adrian, is I'd collect this separately. DSG as a proportion of usable revenue reserves, I think that's now up to 45%. And last year, there are 8 authorities whose DSG deficit was larger than the entirety of their usable revenue reserves. And I reckon it'll be 30 or 40 this year with the run rates that we're currently on. So, I mean, the grants, even at 90% or 80% or whatever it turns out to be with the little sort of side fiddles going on, will still make a huge difference, I think, in terms of I think a lot of authorities would have just fallen over or would be very close to falling over without that. It's still not here yet, though, is it? So it must be it must be a tough job for a lot of treasury managers with short-term borrowing at the moment.
But that's going to be a huge infusion of cash into lots of councils come the early autumn, isn't it? When those amounts are finalised and paid over. Yeah, so Andrew's got to go. That's good. Thanks, Andrew, for that. Martin mentioned that TfL do serve some parts of the country that are affected by LGR, bits of Essex, and further afield. Any other questions that we've got outstanding? It's incredible. We've ended up not talking about LGR, just talking about second deficits.
I wonder if everyone's just fed up with talking about LGR now.
Yeah, I think probably the case.
Kirsty's still here. Kirsty loves LGR. Come on, Kirsty.
Morning all.
Hi, Kirsty.
I was hoping there was more than one Kirsty on the call.
No, there's only one. There's only one Kirsty Nutton. That's what they chant around Rutland anyway.
Thanks, Dan. Yeah, love a bit of LGR. Just so people know, if to make sense of that, Dan, you helped us, didn't you, on one of the proposals a bit. So yeah, all of last year, like many of us, I think, was spent this time last summer. I think was on LGR. So yeah. And Adrian, we used your model, so it's good to see that the progress being made on your model as well. It's really useful.
That's good.
Yeah,
that's good. Are you getting any? Do you expect any proposals in Leicestershire to be parish based, or are you hoping for it to be all?
What the Kirsty?
Yeah, who knows? I think you'd be brave to take any bets. I think, wouldn't you? So I think likely reading, if we take what's already been announced as a guide, like you've suggested, it's probably a proposal that none of the three, proposal have been put forward covers. So it is frustrating that they set out the criteria and we're not really clear what they're basing that direction on. I find that hard.
Yeah.
Yeah, I mean, if you take Brighton as the example, so it might be an enhanced Leicester, mightn't it? And same with places like Nottingham, Derby, all manner of places where I live. Plymouth, Torboy, Exeter did put in a sort of enhanced city-based one. That they look like they're the favourites at the moment. Adrian's already said that cutting up parishes and wards is a big job, but it almost feels like the government saying, well, it's a big job, but you lot can do it. But I just think, apart from the disaggregation of funding and the balance sheet, it's just like your systems for planning and environmental health, and that's going to be an absolute nightmare. Surely those of you that are in Norfolk, Suffolk, is it Hampshire, the other one? There must be lots of headaches, logistical headaches.
I think even as well, like a bit closer to home on council tax systems, simple things like our reference numbers. If, because all of our district type and collection fund areas, we've all got our own systems, haven't we? There's not many of us that share potentially. So just on some of those, it's not just a matter of transferring data over, is it? There's a fair bit of mapping. Even on simple references as well. Yeah,
but no one's ever split a revenue system in an LGR before. So that's going to be something that's going to be happening. The only thing is we're still waiting for these judicial reviews to finalise. At least I think 2 counties at least have started proceedings, and that will be the thing that will potentially make a big difference. And to be honest with you, Kirsty, I'm not looking forward to spending the summer doing disaggregation based on ward boundaries. To be honest, I think it's something better to do if we could. Yeah.
The only other thing, and I think we do it as a bit of where else do we go? Is the materiality? Is there a materiality trump card on splitting up parishes that might help us? I don't know, and that I guess is then based on aggregation, isn't it? Depending how many areas are being split.
Yeah, I think if it's a few wards here and there, in one county it's just a couple of wards that might get transferred over, but that's one thing. But I think for like the Norfolk and Suffolk and Hampshire ones, they're being like in one case there were a couple of districts that have been split 3 ways, so that has to be done. You have to go down to that level. There's always the worry as well that if you don't do it fully, that you're missing something, and it's actually misrepresenting materially. It's always that worry with these funding formulas. Small things can make big differences.
Yeah. Yeah, and often you have to prove it. Like with IFRS, wasn't it? There was a lot of work putting in proving that something wasn't an issue, as opposed to actually driving the change forward.
Yeah. We've now proved it's not material. Yeah.
Nick from North Yorkshire's put, I'm glad we got in early.
I know.
Well, I'd expect nothing less of Yorkshire. Yorkshire's always the first one there.
Yeah. I think Nick, civil servants said, well, North Yorkshire were fine, so why won't you be fine? But North Yorkshire it went very well there. So you've let us all in for it there by doing it so well.
That's absolutely it, Adrian. Yes, yeah.
We're all blaming you, Nick. Yeah. Yeah, and then, but Gary's gone on to Lancashire, hasn't he? Obviously likes LGR so much, he's going to go and do it again.
That is one of the reasons he's gone, Adrian. He tells me is because he liked LGR so much. So he must be unique in the country, I think.
I think he is unique in the country. I think he definitely is. Yeah, that's brilliant. And I think we're probably about the end of it. Lots of stuff here. I think we're definitely going to be coming back to LGR quite a lot over the next 18 months, unless these judicial reviews are successful, in which case we can, I think if one of them is successful, it's probably all over. We'll go back to doing what we were doing before, but we've got to assume that it's going to continue. And Ascend's going to be in massive as well over the summer. We'll continue our work respectively on accounts and on the MTFP model, and we'll report back to you fairly soon. You'll have a webinar, won't you, soon, Dan? Early July, won't you? A quick webinar.
Yeah.
On your stuff. Yeah.
Yeah. Hopefully we'll get all, if everyone's done 30th of June, have a lovely couple of days wading through them, and we're hoping for our members at least to get something out quite early, and then do a webinar on it as well. So
yeah, that'd be great. Look forward to that. Exactly. Fantastic. Well, thanks everyone for coming along. Recording will be available Thursday, and we'll see you all very soon. Thank you. Cheers.
Thanks everyone.
Cheers. Thank you. Bye-bye.